Hello everyone. Today we are starting with the topic depreciation and it is covered under section 32 of Income Tax Act. And depreciation we will cover this topic under the chapter PGBP. So in the previous videos I have covered with other sections and 32 is the most important section that deals with the depreciation. Now if you remember that you have studied P&L account in a plus 1 plus 2 and other classes also. So always you have shown two depreciation on the debit side of the P&L account where you write on all the expenses. So that means depreciation is such an expense which has to be written in the P&L account on the debit side and you show that as an expense. And income tax gives you a liberty to take that expenditure as an deduction. That means whatever expenditure you are going to write down on the debit side of P&L account, for that amount you can claim deduction. Fine. But whatever we calculate depreciation in the accounts, in the previous classes that you have studied, the method of calculation of depreciation is way different from what income tax tells you. So in income tax, we will study altogether a new topic of depreciation, and the Income Tax Act asks for that depreciation which is calculated as per income tax but not as per the P&L which you have studied in the previous classes. Okay, so from the point of view of income tax, there is a different method and there will be different rates also that we will study in the upcoming lectures. Okay, so let's begin by discussing its definition. So depreciation is an admissible expenditure and that can be allowed as deduction under section 32. So whatever expenditure you have done on the depreciation, that depreciation can be allowed as deduction. That means for that expenditure you can take deduction which is covered under section 32. Okay, so but the point is that depreciation should be calculated as per the Income Tax Act and not as per the P&L account or the accounts which you calculate. Okay, depreciation has to be calculated as per the Income Tax Act. The provisions, the rules and regulations provided in the Income Tax Act, those rules and regulations has to be taken care of while you calculate depreciation in the chapter PGBP. Okay, now when we talk of depreciation, there are three things which we will study. One is normal depreciation for the block of assets. Another is additional depreciation, and next is normal asset-wise depreciation. Now, these are the things which need to be covered under the chapter depreciation. Now, I will discuss the block of assets in this video only, and we will discuss these things in the upcoming videos. What is block of asset? What is additional depreciation? All these things will be covered in upcoming lectures. Okay. Now, why there is a method, why there is a need to calculate depreciation? Because whatever the depreciation you calculate under the financial accounting is way different from what we actually calculate in your income tax act. So hence there is a reason that you need to calculate fresh depreciation for the purpose of claiming deduction under section 32 of Income Tax Act. Okay, so there will be different rates of depreciation, there will be different method of depreciation which you will study. Now, depreciation can be charged on two kinds of assets. One is tangible and one is intangible assets. Now, under tangible assets, we have three classifications. One is building, another is plant and machinery, and third is furniture. And under intangible assets, you all know what all are covered. It is goodwill, patents, know-how, trademark, copyrights, etc. Okay, so all these things are covered under the intangible assets. So depreciation is basically bifurcated into two type of assets. The depreciation is going to depend upon the type of asset. Either it is tangible asset or it is intangible asset. If it is tangible asset, then it has further bifurcations, that is building, plant and machinery, and furniture. And if it is intangible asset, then you need to see what kind of intangible asset it is. Okay, and whenever we talk of building, building does not include land. Why it does not include land? Because land is never depreciated, it is always appreciated. Okay, and Depreciation is charged upon the superstructure. Superstructure means the thing which is constructed upon the land. So because land is never depreciated, hence the building does not include land. Okay. Now, this is a prescribed rate which you need to remember in order to calculate the depreciation. Okay. So I have mentioned all the classifications here and the rate of depreciations as well. So first classification is building. If building is of residential nature, and in the residential nature building you are doing your business or profession, okay, then that residential building will be given rate of 5%. That means depreciation will be charged at the rate of 5%. If there is general building, then there will be 10%. And if there is any temporary structure, you can take an example. Supposingly, many of the films are being shot and shooting is being done and temporary setup is being done. Okay, that kind of thing can be taken under temporary structure. Okay, so under that it is given as 40% of depreciation. Okay, then another category of furniture and fittings. On the furniture and fittings, there will be 10% of depreciation. If you ask that you need to remember these rates, so yes, you need to remember these rates. Okay. Then another category is plant and machinery. Under plant and machinery, our first category is motor vehicle. Motor vehicle has again two parts. One, used for business of running them on hire. For example, Ola and Uber. Okay. So on that, there is a rate of 30% depreciation. And other than these other motor vehicles, there is the rate of 15%. If there are ships, then it has a rate of 20%. If there is aircraft, then it has a rate of 40%. Then there are computer laptop. And whenever I talk of computer or laptops, it include its accessories as well, such as UPS, pointer, or scanner. Okay, but it does not include the mobile phones. Okay, and upon computer and laptop there is a depreciation of 40%. Another is books. Books means any person who is using the books for his profession. Supposedly there are lawyers, and lawyers all the time needs a lot of books. Okay, so if there is annual publication or another other than annual publication as well, it has a 40% of depreciation. And if person is having any library business itself, so upon that also there is 40% depreciation. Okay, then there is another category of windmills and its equipment. Then it has two cases. One, if the windmill is installed before 1st April 2014, then its rate of depreciation is 14%. And if it is installed after 1st April 2014, then its rate is 40%. And then there is pollution control equipment. If you have pollution control equipment, upon that the rate of depreciation is 40%. If there is another plant and machinery other than these which has been discussed, then its rate is 15%. And if you have any oil wells also, and on it the rate of depreciation is 15%. Okay, so these I've discussed all the tangible assets. And talking of intangible assets, whether it is goodwill, patent, trademark, copyright, software, websites, anything, so it has a rate of 25% as depreciation to be charged, right? You need to remember these rates, right? Now, coming on to the topic of how to calculate the depreciation. Now, the method of calculation purely depends upon the type of assessee. If the assessee has the business of power generation or power distribution, okay, then it has the option to follow with the straight line method or written down value method. But thing to be noted here is, or to be kept in mind is, whatever method these assessee adopts, that method will be adopted every year. In between the years, the method will not be changed. Okay, so option to be exercised before furnishing the return of previous year in which they have started generating the power. So this option they can exercise before they file their return, whether they want to adopt their SLM method or whether they want to adopt WDV method. And other than the business generation power generation business, Another SSEs, all other SSEs, they have to follow WDV method. There is no option given to them. Okay. So straight line method is charged upon individual assets, and written down value method is charged upon the block of assets. Now what is block of assets? Those assets which has same rate and which are of same class are put together, and that togetherness is known as block of assets. For example, the SSA has purchased an asset on 1st April. Okay. So it has purchased two aircraft, one costing 100 crores, second costing 200 crores, and two ships one costing 300 and another costing 80 crores. Okay. Now what WDV method says that WDV depreciation is to be charged upon the block of assets. So we will make this aircraft which is of one class and upon which the same rate of depreciation is to be charged. If you remember in the previous slide that I've shown you, upon aircraft the rate of depreciation is 40%. So this total value is how much? 300 crores. 100 plus 200 is 300 crores. And upon that at 40% depreciation is being subtracted. So this is written down value. Okay. After subtracting the depreciation, the value is 180 crores. And same is the block number 2. That means these ships which are of same class and has same rate of depreciation are put together. So it is 300 plus 80, that is 380 crores. And when you calculate depreciation as 20%, it comes out to 76, and remaining value is 304 crores. So this is the meaning of block of assets. So which are having same rate and same class are being put together. Okay. Then another case is of proportionate depreciation. Now this topic says that depreciation is to be charged when the asset is being put to use. Now there is a difference between ready to use or the date of purchase. You may have purchased asset today and you may not have put to use. Okay. And even if it is ready to use, you have not actually started to use it. So the date on which you have started to use, from that date the depreciation will be starting to charge. Okay. So it is not from the date of its ready to use or date of purchase, but depreciation is to be charged from the date of put to use. Okay. And put to use means this during the same year. During the same year means the year in which you have acquired and in the same year you have put to use. Okay. So this is the case where the asset in which you have acquired and in the same year you have put to use also. So it has two cases. If the asset which you have acquired in the same year and you have put to use, if it is used for more than 180 days, then full rate of depreciation is being charged. If it is less than 180 days, then half rate of depreciation is to be charged. For example, you have purchased an asset on 5th May. The rate of depreciation supposedly is 20%. And you have put to use on 1st July. Okay. So when you calculate days from 1st July to 31st March, when your financial year is ending, it is actually more than 180 days. So depreciation will be given at 20%. And supposingly you have started to use on 1st January, and from 1st January to 31st March, it is actually less than 180 days. So the rate of depreciation will reduce to half, that is 10%. Okay. And if the rate of if you have put to use in different previous year, for example, you have purchased your asset in the financial year 2017-18 and you have put to use in 18 and 19, in that case there will be full depreciation given irrespective of the number of days. That means in that case you do not have to check for the number of days. For example, you have purchased an asset on 30 May 2015 and is also ready to use, but you have put to use in another year. This is the another financial year and this is financial year 16-17. So rate of depreciation is 20%. In this case, you need not to check the number of days it has been put to use. So full rate, that is 20%, full depreciation will be provided to you. So in this very video, I have just given you a brief introduction about the depreciation. In the upcoming video lectures, I will explain it more. Thank you.